فما كنتش عارفه بس تمام. ثانك يو حبيبتي.
اللي جت
هاي يا ريم.
تقييم اللاب عندها.
Good morning, everyone.
Good morning.
Good morning.
Good morning دكتور داليا ازيك؟
Hi, everyone.
Good morning,
ازيكم
Dr.
كلكم؟
Dalia.
طبعا I really appreciate يعني you joining طبعا Jeannie and Dr. May and everyone joining on يعني July day. Thank you so much. When I think Kareem, we should wait كده 3 more minutes till most participants join. Would we do that?
Yes, we can wait for 5 minutes.
Okay, let me know when I'm ready. Thank you.
انت دخلت الميتنج؟
I think we have a good number to start. For the interest of time, this is a very important session. Let me warm up. Let us have a common alignment. What does this session represent, and how does it contribute to our journey at the Federation of Egyptian Banks? As you all know, first I want to welcome Dr. May Attallah and Eugenia Sanchez for joining us, being our we're hosting them in a very important FEB Talk webinar. If I want to introduce, you already have their bios. Very impressive, very hands-on bios. Dr. May Attallah is a researcher, senior researcher at IWMI, which is the International Management Water Institute. May is specialized in scaling and partnership with regards to water and adaptation. And she has a long experience. Prior to that, she was a senior researcher at the French National Institute. Eugenia is a global lead for adaptation at the policy and adaptation lead at the GFANZ, which is Glasgow Financial Alliance for Net Zero. And prior to that, she was with the IFC and with Morgan Stanley. So she has a well-rounded financial expertise. And she holds a degree from Columbia University and a master's degree from Oxford University. And this is the bio, which you all have. But I want to share with you the background story and why did we reach out for them and ask them to join us. The starting point, as you all know, that for 2026, sustainable finance strategy was front and center for all of us. The main focus. Under the strategy, we're talking about adaptation and mitigation. And we realized for a country like Egypt, located in the MENA region, Africa, adaptation is a real priority, and it has been largely under-addressed by banks. And we want to redress this situation. We want to understand why adaptation is important from us, and we mentioned it's about risk management and opportunities. And the main assumption was how to prove the business case of adaptation finance, because at the end of the day, we want to make sure we are profitable. And I shared the brain trust model, which CIB introduced, and how having different business models, different systems within banks could be enough to prove the bankability of an adaptation project with a focus on water or agriculture. And that was easier said than done. This session is the testament, it's the proof of concept. How I started the introduction with IWMI and Dr. May is 4 or 5 months ago, or maybe more, we were introduced to Al-Murunah project. Al-Murunah project is a project, Dr. May will introduce it, but it took place in a governorate in Egypt, smallholder farmers, stakeholder engagement, and this is why Dr. May intervention is very important, because it demonstrates or highlights the importance of stakeholders' engagement in adaptation finance and how they could become profitable. Not only that, you will notice that she addressed adaptation, mitigation, and the social dimension, engaging the community service and creating employment opportunities. I welcome Dr. May. With regards to Eugenia, very important. The background is that we have been engaged with the GFANZ since the start in 2021. GFANZ started with a focus on decarbonization, it's the net zero. But I think by December 2024, 2025, adaptation became front and center, and the GFANZ broadened the scope to include adaptation next to mitigation. And Eugenia and the GFANZ they have a very comprehensive outreach to policymakers, to research, to frameworks and standards around this topic, which constitute a very important stakeholder or actor to prove that adaptation finance is commercially viable. Not only that, less than a month ago, at the London Climate Action Week, Eugenia and the GFANZ introduced a seminar report about 21 case studies in adaptation finance on part of financial institutions. I think the importance of this report was that adaptation finance is starting to be mainstreamed among commercial banks, and more so, how did banks do it? The system implication inside banks, because we cannot prove the bankability of an adaptation project unless you have the prerequisites, systemic prerequisites inside our bank. So I think this is a very important webinar. I can't thank you enough, Eugenia and Dr. May, for joining us. And I can't thank all of you for being present again in the middle of the summer to engage. But this session is much of a discussion around the proof of concept. How can a bank do it? And you take it back to your bank and see what are the gaps, how can we proceed? This being said, going forward throughout 2026, you will witness several workshops, conferences around water and agriculture, and we need to be prepared, and you need to be very much engaged into this discussion with the understanding, how can you build systems inside the bank? Who are the stakeholders that you need to connect with? It's more than an introduction, it's priming the discussion. So thank you again, and I think we will start by Dr. May Attallah. Thank you, May, for joining us, and then it will be followed by Eugenia. And please communicate if you want the questions to be at the end of your intervention or during your intervention. And I will also request Reem to facilitate, to make sure we have a very interactive, purpose-driven webinar. Thank you, and back to you, Dr. May.
Thank you, Dr. Dalia. Thank you for the introduction and invitation. Good morning, everyone. I shared my screen. I hope everyone can see it. Could you just confirm that it's visible?
Yes, we can see it.
Perfect. Yes. So good morning, everyone. Sabah al khair. My name is Maya Attallah. I'm an economist and researcher in scaling and partnership at the International Water Management Institute. I will be delivering the presentation in English since Eugenia will join soon, so she will be able to understand and follow the discussion and start her contribution afterwards. So my presentation is entitled From Water Risk to Investment, Building Scalable Adaptation Pipelines. So today I will talk about how we can move from water risks to adaptation project pipelines. And more specifically, how water, agriculture, nature-based solution can become a part of a scalable adaptation finance pipelines. So before going to the finance discussion, I will introduce IWMI, the International Water Management Institute, بنسميها IWMI. So it's an international research for development organization dedicated for water security around the world. We work with government, civil society, development partner, private sector to solve water-related challenges in developing countries and help scale a practical solution. So IWMI operates in more than 55 countries across Africa, Asia, Latin America, and the Caribbean. We have our headquarters in Sri Lanka, and we have more than 40 years of research and innovation experience in the water sector. And we are a part of a bigger research group called CGIAR, which is a global research partnership working to transform food, land, and water system in climate crisis. So at IWMI, what's our vision? Our vision is a water secure world. this means that we conducting scientific research, developing and testing water solution, using knowledge to strengthen policy, and working through partnerships so that evidence can inform policies and investment. So yes, our 3 pillars, the science-based solutions, knowledge to strengthen policy, and the last but not least is the partnerships. And it builds the discussion for today because we are talking about collaborations between researchers and research institutes like IWMI and financiers and commercial banks. So our work doesn't stop at finding a solution that is technically viable, but we understand the cost, the economic returns, the adoption condition, the governance behind it, and the potential to scale. And this is why IWMI's work connect with the financial institution, because IWMI can provide all the variables and all the data and the input that the financial institutions need to take things forward into scaling and replicating the solutions. So let's talk about water. So the global water crisis. By 2030, global freshwater demand is predicted to exceed the supply by 40%. So that proves that water is not just an environmental issue. Water affects agriculture, production, energy system, industry, and infrastructure. So when water availability determines whether farmers can produce enough to repay the loans, whether a business can operate reliably, or whether infrastructure can be delivered and can continue to provide a service, then the water problem is not just environmental, but it is more of a business problem. And this means that adaptation and adaptation finance, adaptation cannot remain at a grant level project, but it needs to become, like Dr. Dalia said, it needs to be profitable. It needs to be a part of a mainstream economic and financial decision making. So the water crisis also is not isolated. When there is a water crisis, it affects hunger, poverty, exclusion, ecosystems, and also it deepens uncertainty. And uncertainty when it comes to banking and loans and repayments, this is an important topic that we need to try to manage to be able to deliver effectively. So water is not environmental or humanitarian, but it's a transmission channel into financial risks. So water risks, if I talk about water risks, they affect variables that interest the financiers, like the costs, the revenues, default risk, collateral value, business continuity, and the overall portfolio stability. So that's why, like also Dr. Daya said, today's conversation with Eugenia and me is important. It's important that we all collaborate to be able to connect the dots and try to solve the problem and to make adaptation profitable and to move climate adaptation forward. So just a small reminder about adaptation versus mitigation. So climate adaptation is the actions to manage the risks of climate impact. However, mitigation is from the start, actions to reduce emissions that cause the climate change. So as an example of adaptation, for example, it's flood production activities and projects, but for mitigation, it could be how we can use energy efficiently by using solar panel, clean energies, EV transportation. So it was important to clarify the difference between climate adaptation and mitigation, because the focus of today's talk is adaptation, and also Eugenia will take it forward, speaking or talking about adaptation finance. So now let me move to a Mentimeter. Let's see if it works. So you can scan the QR code on the screen with your mobile. You can connect to menti.com using this code. And I would like to ask you a question from your perspective. So what is the biggest barrier to financing water adaptation? give you a few seconds and then we can discuss it afterwards. Your input will be important into bridging this gap about what us researchers see and experience, and what you as financiers from the asset side also experience. So now it's about unclear financial returns, limited concessional or risk-sharing capital, lack of investment-ready projects, and insufficient physical climate risk data. Just give it a few minutes so we can have a ranking, but we see that the unclear financial returns is the priority, or the majority of the respondents see that this is the clear barrier to financing. And I understand, because as financiers, if you don't see the clear financial returns of adaptation, and this is a huge barrier that I will discuss it in a bit, how you can finance it. That's why it all joins the idea of the need of evidence, monitoring, evaluation, evidence to have this business case, as Dr. Thalia said, have all the numbers that proves that adaptation is profitable, and then all the stakeholders can gain from financing adaptation finance. So now we have, I think we can stop here, because with the voting, because I see that it's still the first position is for unclear financial returns. The second, it's the lack of investment-ready project, and I agree on this point, because when it comes to adaptation, there are several ideas, innovation ideas, pilots that proved success. But at the end, how to move from a successful pilot to a business case to a product that the financial sector can take forward, this is a gap. This is a major gap that we're addressing. And with our collaboration with CIB, we're trying to bridge this gap and intersect these points of view, so we can move our project forward. Al-Murunah, Dr. Daria gave an introduction about it, and I will also introduce it to you with more detail soon. So yeah, unclear financial returns is the biggest barrier. Us researchers, we see that, and also as financiers, I see that we agree on that point. But just to specify for researchers, is not that financial returns do not exist, but they're not clear, they're not well documented, well monitored. So we can prove that it's in the benefit of everyone to be a part of a project of climate adaptation and beside mitigation. So climate finance is growing, but adaptation remains small and only partly visible. So the track climate finance, according to the Climate Initiative Policy Report of 2026, it's 2 trillion for total tracked climate finance. Out of these 2 trillion, there is 1.9 trillion for mitigation, 64 billion for adaptation, of which private adaptation finance is 3.8 billion. So the 64 billion isn't the market size, it is the size that we can currently see. Why? I will show you later that adaptation can exist in many of the projects. It's either not well documented, not well classified, or a part, not a standalone project, but a part of a big infrastructure project. So that's why at the end, the 64 billion is like underestimating the true size of the market. But it's still a considerable amount that needs our attention and our collaboration. So now speaking the transmission channel from water to finance, how a water shock reaches a balance, reaches the balance sheet. So I've argued at the beginning that water risk is a financial risk. So now let's be concrete. If we take one borrower, which is a farmer or a farming cooperative in the Delta in Egypt, and the groundwater level are dropping, surface supply becomes unreliable. What is the solution? Operationally, farmers need to pump more from greater depth to irrigate their land. So energy costs rise and the yields become volatile. So financially, operation costs increase when there is instability in water supply, revenue changes, and the margins decrease. So at a portfolio level, the borrower's default probability rises, and because the same physical risk affects every borrower in this area, let's take a village in the Delta or a governorate in the Delta, then there is a multiplier effect. That means that everyone is at risk. So the default probability increases. And this risk is not only water and agriculture, but agriculture is food, is energy, is logistic and transportation of goods. So all of these sectors and chains are connected. At the same time, let's take another example of a flood. If there is a flood, then the physical damage becomes a business interruption. There is a loss of cash flow, and then there is a reduced collective collateral value. So this is basically to show you how the water risk can just transmit into the operations, financial effect that affects the portfolio and the banking sector, and should be a topic of interest to all of us. So why adaptation stays hard to finance? So there are many reasons why adaptation gets little finance. So it's context specific. So there's no universal technology list or a single unit like mitigation with tons of carbon to quantify it and classify it. The second is about that the data is poor. So local hazard, asset, and performance data are limited or expensive, and the benefits from adaptation are hard to monetize. And this is what we try to do at IWMI, is to run a pilot, see the benefits, try to monetize them. It's not an easy exercise because the benefits appear as avoided loss and the reduced volatility rather than mitigation, which there is a new revenue stream and it's straightforward. The third point is that it's fragmented. So an individual farmer or a small holder does not is too small to justify a full due diligence. So most opportunities are not investment ready. It needs documentation, governance, monitoring, which are incomplete in case of small fragmented project. And yeah, this joins the last point of fragmentation leads to no investment ready pipeline in climate adaptation. So here where IWMI comes to solve the problem, and here where we can provide value to make adaptation more concrete. So the answer is to build the evidence layer between risk and capital. So how do we do this at IWMI? Our role is to build evidence layer underneath the credit decision. So that means 4 things. First, we diagnose, identify the water risks, the exposed asset, vulnerable value chains in a specific place. And then once we diagnose, find the problem, we design the solution. Implement the solution, and testing in real operating conditions. And once we test the solution, we now see the impact of that solution. We measure the impact and translate and convert outcomes into costs, savings, avoided losses, and risk metrics. This translation is very important to bridge the gap between researchers and the banking sector, where we can show the variables that interest the banking sector, and how, as Dr. Salia said, from this here, we can build the business case. And lastly, building the pipeline which standardize, aggregate, structure, and monitor. So in short, we move an intervention from there is a pilot, it works, to it can be assessed, it can be measured. So you take it forward, it can be financed and scale. So let me show you in practice what it looks like. I will, Dr. Dalia introduced Al-Murunah project, the project where we collaborate with IWMI and CIB. And now let me give you more details about Al-Murunah. So it is a project that's a regional project in the MENA region. It's in Egypt, Jordan, Lebanon, and Palestine. But let me focus on the Egypt case. So it's what we are collaborating with with CIB. So we have a package of interventions that solve problems of water scarcity and soil salinity in the Delta region. So these are the major problems. So we diagnosed the Delta, we saw the problems, we built effective solutions that can make things better. So what are these solutions? The solutions are regarding water and energy, there is the solar power irrigation system we installed and the laser land leveling. Laser land leveling is basically using tractors to make the soil homogeneous and smooth so we can consume less water while irrigating and not suffocating the seeds. So it also needs to less loss when it comes to seeds and water. There is the land and food treatment, so the salinity recovery, which is some techniques to solve the soil salinity problem, improve the quality of the soil, which improves productivity, and the agro-processing value chains. Agro-processing value chains, it's after that we have the seasonal crops, there is a small agro-processing facilities where women can work to add value on a crop. In our case, is the artichoke, and sell it on the market and sell it to factories and to aggregators. And finally, governance and adaptation. So we introduce a water user association, this association of farmers that can govern the asset, which is the solar panel irrigation system that we installed, maintain the asset and manage the asset overall. And also inclusive decision making, which is trainings and mainly trainings for women to train them to make joint decisions in the household and to add their value in the agricultural value chain, whether with the agro-processing facilities or with participating in the decision making. So this is, I gave you a brief idea about Al-Murunah project, what we installed. So these are the solutions the package of solutions that we put on the ground to be able to solve the problem of water scarcity, soil salinity, and gender equality. So we can reach better results. So what are the results when we invest in this nature-based solutions? There is water savings. There is any 10 to 20% water saving. There is an increase in yield, 15 to 20%. There is a decrease in salinity in MMOs. This is like from 4,000 to 1,500 is it's a good result. I know that it's not maybe that speaks to everyone, but it's a decrease in soil salinity that can show an increase in the quality of the soil, the sustainability of the soil, and the overall yields, and 50% increase in women income because we created an economic activity for these women to process the artichokes, add value to them, and sell them on the market. Before, some women did not have an economic activity at all. So how we can translate from here to the financial relevance for you. So the solar irrigation, it eliminates diesel exposure, so it has a lower and less volatile operating cost. The laser leveling, it reduces the water requirement, so it guarantees a more stable production. Salinity recovery restores the quality of land, which preserves an stable income and asset value. Agro-processing facilities diversifies household income. So in financial terms, it creates a greater shock absorption. And lastly, water governance. It improves the operating and maintenance and management of the asset, which translate to a lower performance risk to the financiers. So that's how we put on ground interventions, test them, prove that they work, translate this evidence into variables that's of interest to financiers and to everyone, so we can work together and advance climate adaptation. So yeah, basically this is the what I just explained. A pilot proves performance, scaling creates market. So there is the validation of the evidence, standardization of the package, the aggregation, because we need to pool farmers and assets to make adaptation visible and to make it smooth and homogeneous and manageable. Structure, match commercial and concessional capital, and in last step is institutionalize, embed these efforts in policy and delivery. So from evidence to transaction, what is the missing middle? So even with all of that, evidence alone does not produce a transaction. You still need a defined borrower or off-taker, capital and operating cost model, repayment source and cash flow projection, risk allocation and credit enhancement, aggregation and delivery mechanism, governance and operation and maintenance, adaptation eligibility, and monitoring and verification, all the MEL that we need. So this slide shows that this is the missing middle between research and finance, and this is where we can move a project from just a pilot that worked, that has evidence, into a project that the financial sector can take forward. So adaptation finance needs an ecosystem, not just one institute. The ecosystem is the commercial banks, central banks and regulators, governments, multilateral development bank, the FIs and climate funds, technical partners, which are our partners for implementation of the solutions of the ground, and business and communities. And in some projects, they maybe underestimate the added value of the communities, but in Al-Murunah, or the approach that we use at IWMI, is that community is at the center of the implementation. The solutions are from bottom up. So we see with the communities what are the solutions that they need, what are the problems that they face, and what are the solutions that would make basically their life better. So we implemented and then take the pilot forward. So before I end my talk, I would like to talk about IWMI and what we are doing to bridge this gap between research and finance. So we prepared a guidance note that will be published soon, and I can share it with all of the audience when the publication is finalized. It's about NDCs, which are the nationally determined contributions, and NAPs, National Adaptation Plan of the government. So it's basically the climate adaptation plan that the government of Egypt has put to see how they will take the adaptation forward in the upcoming years. So we translate these terms in this guidance note into investment signals to say to financiers that there is investment opportunities in this national adaptation plan, that you should take forward, invest in these sectors, because there is a co-financing entry point, there is de-risking, and there is it's backed up by the government since it's a government priority. And there is a second guidance that is under development. It's about project appraisal and how we can integrate nature-based solutions in project appraisals. Nature-based solutions, it's a topic that could take another session, but they can be a standalone project of nature-based solution, but they can also be a smaller part or a criteria from a big project, a big infrastructure project. And this is the guidance that we're trying to find ways to incorporate nature-based solution into project appraisal so we can increase the share of climate adaptation. So to end my talk, the gap here, or the key message is that adaptation finance to scale does not only scale because of the need, but it scales because when the risks are visible, the benefits are measured, and the projects are structured in a way that financial institutions can assess and finance. So thank you for today, and let me know if you have any question. And I think after the questions, the plan is to have a 10 minutes break, but Reem, feel free to interrupt if the timeline changes or if you need to add anything. But thank you for listening.
Thank you, Dr. May. I think that was very comprehensive and insightful. Lots of takeaways. And I would conclude by the slide where you mentioned that evidence are there. What we need is concluding transactions and the missing middle. And I think the missing middle is the financial institutions. Financial institutions have all the capacity and very much poised to make the difference in the adaptation file. So now, Reem, could you please manage the time and the questions? I can see Mona Bidir.
Yeah, sure. We can start with the questions and then go for a 10-minute break and return back at 12:30 to continue with OGD. We can start with Mona.
Hi, everyone. Hi, May. Thank you for the presentation. Very insightful as usual. I just have two questions. The first question regarding your methodology to assess the project selections. I mean, how IWMI decided, for instance, to go for Kafr Sheikh, a village in Kafr Sheikh, to determine this is in need for adaptation measures with a significant impact can be measured. And my question related to the data, because we always talking about how the end of the data would hard to identify or measure the impact or identify the hazard in a way that we can say that this project will generate a significant adaptation impact. So how IWMI see this as an obstacles and how overcome such a challenges of data selections. My second questions are regarding your implementation of Al-Murunah. I know you work in Al-Murunah in Egypt and Palestine, I think in Lebanon as well. I mean, in Arab region, we know that we are suffering from a clear hazard related to water stress. By my questions, to what extent to see that regulations in different countries can affect the scaling project like in Al-Murunah. I know for Jordan, for instance, they already have now a green taxonomy. Do you see this as important steps and such document or such classification can help scaling Al-Murunah project? Or more like let's say on ground or community engagement is more important and can drive more or can overcome a regulatory gap. And thank you for the presentation.
Thank you, Mona. I was taking notes of the questions. I hope I didn't miss anything. So about the pilot collection and the data collection selection and the data collection afterwards in IWMI. So when we decided to start Al-Murunah project, there was to choose the area, we just see what areas are the most impacted when it comes to the effect of water scarcity and climate change. And they face major challenging that we can tackle, so we can maximize our returns, because there are more areas that they suffer with less problems, areas that have more problems. So just to maximize the utility of the project, we need to implement it in an area where we can have a clear value, where we can help the communities, and when we can have evidence and solution that are replicable. So our aim from the beginning is the scaling. It's not just that we have a successful pilot, generate the data that says that the pilot is successful, and we move on to the next project, because this is just a loss, because if there is a successful experience, so why not taking it forward? So we select the pilot based on needs, on community needs, on environmental needs, and the solutions that we see can solve the environmental problems, and on the scaling aspect, because some solutions could be very context specific, that are not, maybe cannot be scaled to other villages or to other governorate in from the delta to the south, or the opposite. So we would like to have a solution that is scalable. And for the data collection, from the beginning of the project, we have the MEL, monitoring, evaluation, and learning, with indicators that we collect periodically, so we can see how these indicators evolve over time during the time of the project. And then these indicators form our data and our evidence that we use to communicate and translate evidence to people all over the sector. So the monitoring, learning, and evaluation indicators are economic, financial, biophysical, environmental, because we have this physical implementation of solar panels, and we want to see how it changed water, energy, soil quality. So it's a mix of these aspects that make, at the end, a pilot that is successful. And we care about the MEL, because this is what generates evidence, and this evidence is what we all need, researchers and financiers, to take things forward. So the second question is about the regulation versus the communities. I see them as equally important, and we see, because we worked in different contexts in the MENA region, actually for the regulation, it is very variable from Egypt to Jordan to Palestine, and Palestine work in West Bank. So it's very challenging there. We cannot, for example, just we cannot have infrastructure, heavy infrastructure, or like solar panels, for example. It should have, implementation should have a certain criteria, not to build or not to have an infrastructure. So in Egypt, there is no problem. In Jordan also, there is no problem. So the design of the project is very dependent on the regulations, or what is permitted here and not permitted here, and what's scalable here and not scalable here. And other than the regulation, there is the communities and the community needs. Because in the MENA region, from the experience at IWMI, we see that there is a gap between community and regulations. We try to bridge this gap. We try from communities to build the model bottom up, have the solutions, and then scale them, upscale them into policies from the regulation side. So I think that communities can help overcome the regulatory constraints, but cannot deliver 100% of the solution. There is no, there is a clean taxonomy in Egypt. There is not, in Jordan, but there is not yet in Egypt. And you can correct me if I'm wrong. And I think this helps. This helps in the conversations, and this helps in how the government see the implementation work, and how we can translate our findings. I hope I took note of everything, and I answered all your questions. Let me know if anyone of the audience has more questions. Or if there is no questions, maybe Reem can take it forward.
Hi, does anyone else have questions for Dr.
Yes,
Mai,
please,
or we can
Reem.
go for the break? Oh, Nadia, go
Yes,
ahead.
please.
What are the ways of cooperation with banks in these kinds of projects? You provide the technical assistance and the risk measures, and what are the ways of cooperation in the well, only the research part and the banks turn to you for the research part in this areas?
Thank you, Nadia. This is a very important question because this is actually what we are working on with CIB, and to see what each of the what everyone can bring, so we can move the project forward. We can move it into a commercial product. Maybe I didn't have time to talk about carbon credits and solar panels, but like every stakeholder has their expertise. So on IWMI side, we have the research, the evidence, the on-ground, the experience was on-ground implementation, and the governance structures that we put in place to make sure that when a bank finances solar panels, for example, or any other asset, we put the governance structure to make sure that the assets are well governed and well maintained. So we provide technical assistance and participate in the project or the product design. And yeah, as Dr. Dalia mentioned, this slide of the missing middle, and yeah, I think this is the missing middle that where the banking sector can take it forward. But yeah, as you said, it's mainly evidence, scientific evidence, piloting, scientific evidence, and technical assistance. Thank you.
Thank you very much.
Okay. Any other questions, comments to May before I conclude? Okay. I need to give you enough time for the break. I can't thank you enough, May. It's a very well developed presentation. I'm sure every participant has his or her takeaways. If I may conclude, adaptation is profitable if the right stakeholders are there. There is a role to be played by banks to scale. There are hundreds of successful projects here and there that need banks to scale. Another very important statement that you mentioned is that communities could trigger the change, even if the regulatory scene is not 100% right. And this is a very powerful statement and experience, because communities, civil society, banks, they do have the energy and the momentum to start the change. And industry actors are very important for the real economy transition. So let's not always say that the legislative or the regulatory scene is not there, because we have DFIs, we have civil society, we have communities, and banks sit very much in the middle. And special thanks for IWMI that you included Palestine, the West Bank, and I think this is very courageous. It's not only that you are overcoming regulatory hurdles or financial hurdles, even political hurdles. And this demonstrates that communities are capable of driving adaptation finance, because at the end, it's our survival. It's our risk as banks and our opportunities. So thank you so much, Dr. May. Back to you, Reem.
Thank you, Dr. Dalia. Thank you, Reem.
You will share the excellent presentation. It will always be an excellent.
Thank you. I will do so.
Thank you.
Thank you so much, Dr. May. We can take a 10-minute break and return back at 12:35 to continue with Eugenie.
Thank you. Bye, May. We would be pleased if you continue to join us. Huh?
Yeah, I will be there for Eugenia's presentation, of course. Thank you.
Hi, Dr. Dalia, we can start.
Okay. Welcome back, all of you. Before Genia, I already introduced you when we first started the webinar, but now I need to thank you a lot for joining us. Genia is in New York, and now it's 5:35 a.m. And I saw you drinking coffee, but you look perfectly tuned, perfectly energized. So thank you so much for joining us despite the time zone difference. And again, for a quick introduction, Genia is a global policy and adaptation lead at the GFANZ. Prior to that, she worked with the IFC, Financial Institutions Advisory Group, and you started your career in Morgan Stanley. So this means that you know very well how bankers think, and you have a well-rounded exposure to fintech, financial solutions, and digital payments. Very rich experience. As you know, we at the Federation of Egyptian Banks, we have been very much systematically integrating sustainable finance across all banks in Egypt. We have been progressing. We managed to lay down the foundation. We have a very progressive and proactive regulatory central bank. 10 days ago, they issued a regulation circular to all banks mandating climate risk management or transition finance. Adaptation is front and center for all of us because it has the risk and opportunity side. So we're very much looking forward to tell us your experience. As I mentioned when I first introduced your part, although the GFANZ started with mitigation and decarbonization and the net zero, you found it compelling more than a year ago to broaden the transition to include adaptation finance because it's extremely important and very relevant and very compelling to this part of the world. So thank you for joining us. Thank you for making it at dawn time, and we're all ears. Thank you.
Perfect. Thanks for that. And yeah, there's no way to wake up quite like hearing about adaptation. It's very invigorating first thing in the morning. So it's great to be here. And thank you everyone for joining. Thank you, Reem and Dr. Dalia, for organizing the session and for all you've done to support our work on adaptation at GFANZ. And also thank you, Dr. May, for your great presentation, which I hope I have some complementaries to share that I think will be nice and complementary. I'm just going to share my screen, which hopefully you can see. But yeah, my name is Eugenia Sanchez, and as Dr. Dalia mentioned, I lead GFANZ work on adaptation finance, which is a relatively recent focus for us. But so that's really what I'm going to walk through today is that work on adaptation finance that we've been doing and what it looks like. The core message really is really a hopeful one, which is for a long time what we've seen is that adaptation has been framed as being way too difficult to possibly finance, or it being largely something that the public sector needs to take the onus or responsibility for. But really what we found through our work at GFANZ is that in many, many cases, private finance is already moving. And especially with leaders like SIB, what we're seeing is that, there are already really successful models in place. And really the task now is to take stock of what's already working and then work to make that repeatable at scale. Let me just start with a quick word on who we are. For those of you who may be less familiar with us, GFANZ is short for the Glasgow Financial Alliance for Net Zero. We were founded at COP26 in Glasgow, hence the name, by the now President or Prime Minister of Canada, Mark Carney, as well as by Michael Bloomberg. Essentially, we are an independent private sector-led initiative that brings together banks, but also insurers, asset owners, asset managers, and service providers from around the world, all of whom are just interested and committed to the opportunity created by the transition to net zero. In practical terms, what we do really is we focus on helping drive transition finance and unlocking private capital at scale. Partly we do that through capacity building, and partly we do that by helping to develop innovative financing solutions that others can then replicate. We work both globally and also regionally through a set of regional networks, including one in Africa, which matters for adaptation because so much of the need and so much of the data and policy context is so highly localized. So as Dr. Dalia mentioned in her introduction, over the past couple of years, as the physical impacts of climate change have become more frequent, more severe, and more difficult to ignore, GFANZ has deliberately sort of expanded its focus from net zero and mitigation in our early years to also include adaptation and resilience finance. And really what we've done is to date is really put out three main outputs as part of this work. The first thing we did was last year we provided some sort of structured private finance input to the South African G20 presidency. They had asked us to sort of represent the voice of the private sector to their work on barriers to adaptation finance, and they wanted to understand sort of the current state of physical risk assessment and the main barriers to actually scaling adaptation finance. The second is a curated guidebook of adaptation resources, specifically for financial institutions. And the third, and this is really what I'll focus on today, is a series of detailed case studies on practical financing approaches focused on very specific projects and transactions that have successfully worked in scaling financing for adaptation and resilience. So taken together, I think these three outputs have sort of reflected a deliberate shift in the conversation. You know, I think we started with why adaptation is hard to finance. And we've really sought to shift that conversation from why it's hard and what are the barriers to how private finance can and is actually already doing it in practice and what can be learned from that. So as I mentioned, we did some work for the G20 last year where we basically, in order to provide this sort of private finance perspective, we engaged more than 60 financial institutions globally across a series of regional workshops, and we ended up submitting an input paper, which anyone can access. The QR codes for each of these reports is down on the slide. But basically that input paper, which sort of went into the G20's ultimate deliveries for adaptation and resilience last year, set out what the main barriers were from a private finance perspective. I would say that those barriers are now pretty well understood. I think Dr. May touched on a lot of these in her presentation, but you know, the challenges have to do around the benefits being hard to measure, being diffused, the fact that they're often realized as losses avoided rather than income earned. And then layered on top of all that is really considerable data gaps, inconsistent methodologies, mismatches between time horizons and risk return profiles. So because of all of that, I think we've long seen that adaptation has been treated as primarily a public sector responsibility. But we've really, within GFANZ, tried to shift the focus from diagnosing barriers to developing and surfacing practical solutions. And really what we found from talking to, at this point, over 75 financial institutions is that despite the very real barriers, private finance is already moving. Banks, insurers, and asset managers are all in their own ways finding ways to finance resilience today. In many cases, they're just not recognizing it or labeling it explicitly as adaptation. But in many cases, they're doing it on purely commercial terms using entirely conventional instruments. And yeah, I think in general, we're finding that a lot of resilience financing that's happening today is happening sort of inside ordinary lending or underwriting and investment decisions. So part of the work is kind of simply recognizing and naming what's already going on that's not currently being labeled or recognized as anything having to do with adaptation and resilience, because that sort of lets us learn from what it is, where it's working, and how we can repeat it. And the second point that I'll say has come out of all of this work engaging the private sector is just the sheer size of the opportunity and the fact that it spans sort of the entire economy. A statistic that often gets cited is that building resilience to a 2-degree world could require $1.2 trillion in annual investment by 2050. And that goes well beyond the things that people usually think about when they think about adaptation, which is usually, you know, seawalls, and that's pretty much it. But it actually goes into agriculture, water, housing, supply chains, operational changes, data, digital tools, and a whole range of resilience enabling products and services. And just recognizing that breadth is an important starting point, because it means that, adaptation is not just some sort of niche asset class, but it's a lens that applies across almost every sector that a financial institution already touches. And it's really about how to make that lens applicable and how to equip financial institutions to apply that lens where they're not yet doing that. So really to evidence some of this and where finance is already leading and successfully doing this, what we did over the past several months is we developed a report that sets out 22 really detailed case studies. And these basically span advanced and emerging markets, and they involve kind of every subsector of the financial sector. So we have banks, insurers, asset managers, and blended finance vehicles. Because when we looked at what was already out there in terms of case studies and financial institutions looking to learn from their peers, we found that one, there weren't many adaptation case studies out there, and two, the few that were there tended to be extremely high level, and they didn't get to the granularity of what made them commercially viable, what metrics were used to demonstrate, commercial viability, who were the parties involved, how were risks measured and mitigated. And so what we did was we set out to build something that was very, very detailed and concrete, and that focused on specific projects and transactions, the actual instruments used, and crucially, whether the approach could be replicated and scaled more broadly, or if it was sort of like a one-off bespoke thing. And so we developed each one of the case studies in close partnership with the institutions that you see in this slide. We bothered Dr. Attallah over many months to develop the CIB case study alongside CIB, and we're very grateful for their partnership on this. But I think that basically what we wanted to do is show that this isn't a hypothetical thought experiment, but these are real deals with real numbers. And I think we found, maybe like 3 contextual points stood out at the beginning, which is that one, every part of the financial system plays a role. We're seeing that banks are really important in terms of originating, structuring, and lending. But you also need insurers that are providing risk analytics, that are transferring risk and finance. You need asset managers and owners that are bringing kind of more longer term capital and aggregation. And in many cases, we found that a lot of the solutions combined all 3 of these roles. I would say the second sort of important contextual point was something I touched on earlier, but just that opportunities span the entire economy. So from climate smart agriculture and water systems to resilient grids, real estate, sovereign risk transfer, these are all captured in the case studies report. And they address hazards all the way from droughts and floods to wildfire and hurricanes. And again, just recognizing that adaptation is not this sort of specific niche asset class that you need a very dedicated sustainability team for, but in many cases, it's actually just a lens that needs to be applied across the organization and across all origination teams. And third, and maybe this is the most surprising, is that in nearly half of the 22 case studies, the solution was actually developed by private capital alone on commercial terms and used conventional instruments. So in other words, there was no public subsidy involved to make it work, showing that this is something that's like increasingly viable within existing commercial frameworks if you can structure things correctly, stack the benefits correctly, mitigate and recognize the risks correctly. It can actually be already purely commercial, which is very sort of antithetical to what you hear about adaptation being a purely public responsibility. So there were sort of like 4 main categories of lessons that we brought out in the report. So first was around building the investment case and sort of how to translate physical risk into actual financial metrics and how to stack the benefits, whether that be in the form of avoided losses, lower insurance premiums, or new revenues, into a single investment case that stands up on its own. And that's sort of like the critical foundational point, is being able to build that investment case. Second is developing the pipeline, because the opportunities are diffuse. much of the work is actually around turning latent need into investable projects. And that involves a lot of sort of client engagement and also aggregation. Third is around the need to establish financing mechanisms. And here again, as I said, something that's sort of reassuring is that the vast majority of these cases use mostly conventional tools, whether that be loans, bonds, guarantees, insurance, equity, that were just simply applied with a new resilience lens. And then there were a few examples of more sort of targeted innovation, but those were really mostly useful where the benefits were especially diffuse. And lastly was just around the need to create the conditions for scale. So having the right government goals and policy and clarity and public data, and also just collaboration across the different financial sector actors. And then in some cases, there's a need for sort of catalytic public capital that's efficiently used where commercial returns alone still are not there. So I'll kind of walk through each of these four in turn now. So on the first pillar around building the investment case, I think that the main lesson that came out was that adaptation really only becomes financeable when a hazard map becomes an actual concrete number that a credit or an underwriting team or an investment committee actually recognizes and works with in their day-to-day. And that translation is really the key step. So on the left here is sort of where firms typically start, which is that they typically combine a kind of top-down view of hazard maps, perils, scenario pathways for different sort of degree outcomes. And then they combine that with a bottom-up view. So looking really at asset level exposure, sometimes through, on-site engineering audits, but also maybe a readiness and governance assessment of a corporate client, including just assessing whether a client has an adaptation plans in place or what it looks like. And all of that really requires a lot of really granular and highly localized data, which is often just simply not available. But again, one of the kind of reassuring things that's come out of this work is that firms aren't waiting for perfect data to act. The sort of like hard work that they're already undertaking despite the data gaps is on the right side. So they're, translating that kind of physical risk picture into financial metrics that actually drive financial decisions. So they're, translating that into loss curves, probability of default, loss given default, expected loss, value at risk, insurance pricing, portfolio stress losses, et cetera, et cetera. And they're really managing to take something that's not the language of financing traditionally and translating it into the language of financing. And so I would say that here, the single biggest friction that firms describe facing is the data gaps, because the information they need is so granular and so localized, and it often goes down to the individual asset. And much of that data is either proprietary or it's inconsistent or it doesn't currently exist in sort of a usable form. And so that's where there's sort of the readiness and governance piece comes in too, is just being able to assess whether a client even has a credible adaptation plan, because that can kind of help shape how a financial institution prices or structures the deal. And something else we're seeing here is that this is another area where insurance companies are starting to take an interesting role. I think, obviously they've spent the last several decades developing the expertise of being able to turn hazards into prices. So they're really kind of leading on this kind of data translation. And increasingly we're seeing that they're turning that sort of decades long expertise into advisory services for clients. And so they're working with corporates, but also with banks and other sub-financial sector firms to help them kind of translate from hazards and exposures into financial metrics. And that's sort of a kind of a meaningful shift also we're seeing in the insurance sector, from insurers being seen as a pure kind of risk transfer body towards insurers increasingly acting as sort of advisors and partners in reducing risk, which is kind of an interesting new role. Here are just some actual like concrete examples from the report, which can be helpful to ground the lessons into something that's can help bring them to life a bit more. So one example is was involved Zurich, the global insurance company, and they essentially worked with a large global ports client, and they basically helped that client kind of conduct a top-down assessment of the client's global footprint to identify what were their most exposed ports. And they then sent in sort of specialist climate risk engineers on site to carry out very specific on-site assessments, and then kind of propose a series of specific engineering solutions that were targeted at reducing the very specific kind of vulnerabilities that were identified. And then they worked with the firm to build the financial case for actually implementing those kind of recommended measures. And so that's now become, for this corporate client, a multi-year CapEx program that's currently being implemented. And it spans over 500 million euros of resilient investments, or pretty significant kind of multi-year CapEx program that came about because of this sort of engagement and education perspective. Another example involved Link and AXA in Hong Kong. So they worked, Link is a sort of real estate investor in Hong Kong, and this was the Hong Kong arm of AXA, the global insurance group. And essentially the two worked together to similarly kind of identify targeted measures that would lower Link's flood risk across its real estate portfolio. And based on AXA's recommendation, Link ended up investing around $8 million in flood and typhoon resilience measures. And then they worked with AXA to actually quantify the risk reduction benefits of those investments, and then were able to negotiate that directly into their insurance contract. And so as a result, they were able to sort of negotiate an almost 12% cut in their premiums, which helped offset a large part of the cost of the upfront investment. So there we see kind of a positive feedback loop where you invest in resilience and you see it reflected in your premium. So you have some savings, and then maybe you reinvest those in further resilience. And that's kind of exactly the sort of value stream that we see is necessary to make the investment case stack up. So I'd say, you know, the common thread across both of those examples is that translation piece that we talked about, where, you know, being able to turn physical risk into a concrete financial number, whether that's a CapEx program or a premium reduction, that then allows a decision maker to act on that. And that kind of helps move resilience from like a good idea in theory or something prudent to do to something that's an actually funded project that an investment team okays and green lights. So the second pillar is around developing the pipeline. And here we see that there's really two main levers for turning kind of latent opportunity into investable projects. The first is engagement. So firms combining risk analytics with technical and financial expertise to help clients surface vulnerabilities. And here, CIB is kind of one of the great examples that we have in the report, because they've set up this brain trust that basically convenes clients, DFIs, technical experts to really figure out how to structure those bankable projects. The specific cases that we highlight in the report involved financing freeze drying and high efficiency refrigeration in the food sector. But it was sort of a great example of getting the right people around the table to being able to kind of turn latent demand into an actual bankable project. Another good example that we have in the report is PIMCO, which used kind of a multi-year engagement strategy to help a bankrupt US utility that had gone bankrupt because of kind of very high wildfire exposures. And so they basically backed the utility's resilience bonds, and that helped fund resilience measures and supported tighter credit spreads over time. And then the second lever is just aggregation. So being able to pool small fragmented projects into diversified funds that can actually meet the needs of large institutional investors. And that kind of fixes or addresses the fact that oftentimes individual adaptation projects are just too small or too illiquid for large investors. And really a great example there is the MUFG Gaia Fund, which is a big blended finance vehicle that originates projects across over 25 countries. And they sort of help turn diffuse very small needs into a single diversified investment portfolio that a large institution can actually allocate to. And then the third pillar is really around financing mechanisms. So here again, as I mentioned, the headline is that adaptation really rarely needs brand new toolkits. In most cases, firms are using conventional instruments, but they're just being applied through a resilience lens. So for example, Macquarie took a long-term equity ownership in a Finnish grid company, and it was able to provide this sort of patient capital that was able to address the time horizon mismatch that often blocks adaptation. And that enabled a 1.6 billion euro undergrounding program, which took buried lines from 41% to 66% of the network and sort of was able to make it a lot more resilient to storms. Here we also saw first Abu Dhabi Bank issue a $70 million blue bond to finance desalination and wastewater treatment. So again, that's sort of, more or less a conventional use of a blue bond, but using the label to maybe attract a dedicated pool of capital and signal alignment with certain water standards. But it wasn't actually, an entirely new product that hadn't been used before. So again, it's really mostly familiar instruments that are being applied with a resilience lens. There are, I would say, a few cases where we're seeing a bit more targeted innovation. So that's usually kind of outcome-linked structures that are focused on turning avoided losses into cash flows. And that's particularly helpful in making sort of nature-based and system-wide resilience financeable. But again, sort of the reassuring takeaway maybe from this for this audience is that you don't need to wait for a new classic class or a new instrument to get started. The building blocks are actually really already in place. And the innovation is really mostly in how you apply and combine those building blocks. And I guess I would, just to end on this sort of fourth and final pillar, which is around creating the conditions for scale, I would say that the key takeaway of the report is that private finance is delivering solutions, but it can't scale it alone necessarily. Governments also have a key role to play in setting enabling conditions. As much as financial institutions are leading the way, and it's always helpful to have, supportive enabling policy. And really that means like four main things from our perspective. That's, clear resilience goals and pathways. So national adaptation strategies, but also project pipelines that create demand and that give the market direction so that firms know where to point that capital. And second is, building that demand with policy and fiscal incentives. So we're seeing in a lot of places where there's regulatory mandates or fiscal signals, that helps make resilience investment more obviously and visibly worthwhile rather than just something that's good to do. And third is just treating physical risk data as a public good. I think a lot of the times we have public meteorological bodies that are sitting on a lot of really valuable, good data, but we need more open and comparable hazard data that kind of helps ease the data burden on firms and that lets everyone kind of price risk on a common basis. And fourth, just I think recognizing and de-risking. I think we need well-calibrated prudential treatment of risk-reducing investments so that when money is spent lowering risk, that's actually reflected in how that risk is measured in prudential rules. And then also, of course, there's a role for catalytic public capital in some cases to be used, where commercial returns currently fall short. And always with a focus on crowding in private money rather than crowding it out. So maybe just to wrap up, as I see we're a little bit past time, I think the hope really with these case studies is to showcase what's already working, and to make the point that in many cases, the financial tools already exist and are already being deployed. In some cases, this is being done right now by sort of the leading FIs, but there's no reason why these are not approaches that can't be replicated and adopted more widely across the sector globally. So really the focus for us now is to take that, what is working and continue to showcase it and help make it more repeatable at scale. And we hope that this case study report, which we hope you'll read if useful to you, can help sort of be an evidence base to support exactly that kind of work. So yeah, with that, I'll hand it back to Dr. Dalia and Reem to close us out.
Thank you, Eugenia. That was excellent, very powerful delivery, excellent energy. And I think you drove the message that the investment case for adaptation is very much there. And you brought into the discussion several examples of financial institutions worldwide using different approaches and different tools. You stressed that stakeholders and the ecosystem engagement are very important. So I think you complemented the message driven by me. So now back to everyone for comments, questions to Eugenia.
Hi. Can I ask? I have two questions. First, I want to thank you for the presentation. My first question regarding the GFANZ work itself, because we know they have done extensive work on transition finance frameworks and integrated transition plan. However, my question regarding how the Alliance plan to embed adaptation. I mean, are we expecting to see another guidelines or framework for transition strategy integrated in the transition plan? Or we are looking for a separate recommendation on how to integrate adaptation in transition plan with different strategy or complementary strategy. This is my first question regarding general the work, how the GFANZ planning to embed adaptation and their extensive work on transition plan. My second question is regarding, you have mentioned that we need to build the investment case for adaptation by know-how translating hazards into financial matrix. From your working on the cases, the different cases that you have presented, do you see this as a task that the bank and financial institution have to work by themselves? I mean, to build their capacity to learn how to translate the hazards into financial matrix? Or it's be better to be a partnership between, let's say, the scientific partner or research partner like IWMI? Which do you see it's more like relevant more or will help scaling adaptation more smoothly within financial institutions?
Yeah,
Thank you.
both great questions. I would say maybe starting with the latter. I think what we're finding with adaptation is that even when it is banks themselves, say, that are developing internally capabilities to translate physical risk into financial metrics, they are doing that by bringing in-house climate experts. I don't think that, a traditional financial institution just has the expertise to know exactly, what a water resilience unit is going to translate. So I think that you need to bring in the right specialists and the right scientific specialists internally. I think what we're seeing right now is that a lot of financial institutions are just doing that within their own organizations. So like they're bringing in the right scientists and they're developing kind of like an internal framework. But I think where things are trending, and again, CIB is a good example of this, is that once those in-house kind of capabilities have been developed with the right scientific partners and the right financier partners and the right expertise all being brought together, I think that hopefully what we're going to see is that being shared across peers rather than being kept internally. So I think that hopefully we're moving at a point where once kind of the leading firms have established really good internal frameworks, and I think that we're there now, that there'll be a lot more cross-pollination and knowledge sharing. And, hopefully sessions like this one and other capacity building sessions can be good avenues where kind of leading firms can be like, this is how we're doing it internally, and this is how you can kind of replicate a similar approach. And I think it's going to have to be an ecosystem-wide effort, and it's going to have to bring in science. But I would say that right now it's really being done at the level of the individual institutions. But I think as institutions mature and they get more comfortable, I think that's going to become more and more system driven. And I think that's necessary and for the best. Obviously, I think firms will always have certain proprietary things that they have as their own as a comparative advantage. But I think sort of the base layer of how to translate hazard data into financial metrics will be much more broadly shared, and hopefully common methodologies are used so that there's consistency and there's no fragmentation, and we can reference kind of a similar set of standards. On your point on transition plans, I would say that we're seeing some financial institutions that are starting to embed adaptation into kind of net zero transition plans, but that's very, very early stage. And I think that I think that existing transition plan frameworks can kind of provide already a lens for embedding adaptation. I think that we might still be a little bit too early in the process of asking or requiring firms to more systematically embed adaptation in net zero transition plans. So I think that will be kind of a longer term journey. And I don't think as GFANZ we plan to put out any specific guidance on that in the near term, just because we're not seeing that that's the biggest area of demand from financial institutions for work going forward. I think that, you know, they would rather that things like data gaps be prioritized or methodologies be prioritized, because those are kind of the building blocks that you need for them to more systematically integrate adaptation in transition plans or to develop standalone adaptation plans. I think ideally we want to see firms developing additional standalone adaptation plans. I think ideally we'll see them have an integrated strategy that addresses transition and adaptation holistically, because I just think otherwise that will create such a burden, regulatory and otherwise, on firms. So I think hopefully we'll see an integrated set of strategies. But I think for that to happen, there's a few hurdles we should tackle first, and then I think that will make it much easier for firms around the world to kind of be able to embed the adaptation angle into their broader transition strategies and net zero planning.
Let me join into this discussion, Genia and Mona. I think what we're focused on as Egyptian banks is building internal infrastructure and systems.
Mm-hmm.
And maybe you mentioned the 4 pillars from the investment case to the pipeline up to scalability. And the conditions for all of this to take place is enabling banks to build internal systems. There are still gaps. And maybe this is why we need frameworks for adaptation. We are building sustainable finance frameworks, but as you said, adaptation is still at an early stage. And we need to accelerate this. So we cannot prove the business case of adaptation unless we have it embedded into our risk framework, we have the eligibility criteria for adaptation finance within sustainable finance framework. And you're perfectly right. It's still an early stage on ecosystem level. But what you want to stress here, they are important prerequisites, and they will scale it further. So it's something that we need to engage with the GFANZ and UNEP-FI, that we need, at least for this part of the world, a lexicon for adaptation frameworks, eligibility criteria, risk frameworks to accelerate banks taking. Now we can see the business case with presentations like this. It says, wow, but easier said than done. So if I may end and conclude this wonderful session, you proved that there is a business case worldwide. Here and there, the profitability is very much there. But what we need to take back to our banks is how to establish internal systems. And I think this is the prime focus for the Federation of Egyptian Banks Committee. So this is our intake on this point. So, Genia, do you have any comment or any other comment or questions? Reem?
I'll sit on my end, but I think those are all very good points that I will echo.
But yes, thank you.
Okay, thank you so much. Thank you so much, Eugenia. We can conclude here. Thank you so much all for attending the session. Have a good day.
Thank you, Dr. May. Thank you,
Thank
Eugenia. We
you.
will discussion, and thanks to everyone who stayed over 90 minutes during July. And thank you all, and we'll take the discussion forward, inshallah. Thank you.
Thank you.
Bye-bye.